La inteligencia artificial y el trading de alta frecuencia son dos tendencias que juntas están transformando la manera en que se comportan los mercados bursátiles. Entenderlos permite identificar los principales factores que permiten proyectar escenarios futuros. Es un honor presentar la conferencia magistral Big Data in High Frequency Trading. Irene Aldridge es coautora de Big Data Science in Finance, investigadora cuantitativa y de Big Data en finanzas, reconocida internacionalmente, y profesora de la Universidad de Cornell, además de presidenta y directora de Able Markets. We welcome Irene to the Risk Management and Trading Conference 2021.
Hi, it's a great pleasure to be here. Thank you so much for inviting me to speak. It's so exciting to be in Mexico City and at the same time, kind of not. And I guess as Maxine pointed out, this is really a feature of data and what we can do with data and the technology. It's an amazing example of what we can do. Anyway, so I welcome all the questions. I think we have 10 minutes left at the end of the presentation to really discuss the questions in detail. But what I'm going to talk about today is how to leverage data that you may have or will have very shortly in the next year or two or whenever to build returns like these. So on the right, you see a chart which are out of sample returns for 30-minute changes in one of the S&P 500 constituents. And it's a pretty smooth line as far as trading returns are concerned. Okay, so what we're also going to, what you can also leverage data for is to build execution, market making, investing strategies, optimize portfolio management, even forecast corporate earnings, and as well as understand which ETFs work better for you, including ESGs, and so much more. And by the way, we have a workshop coming up after this speech. So if you're interested in learning more about all of these developments, just tune in. All right. So let's start with these. So we have several issues with traditional data analysis that we really don't particularly like. Namely, it's overfitting and inability to deal with noisy and missing data. And I'm going to talk more about overfitting later, but right now I'd like to discuss the noisy and missing data. So when I was taking econometrics courses in the university, and I actually was studying with Professor Christian Gouirou, who's very famous in this field, the most important thing he emphasized was really how to clean out the data. So you would take a 20,000 some sample of observations, and you would cull it down sometimes to as few as 200 lines because you wanted to get rid of all the missing observations, all the noisy observations, anything that didn't fit the perfect model. So at that point, and there are lots of organizations that hire presently, specifically PhDs for data cleaning purposes. At that point, you have very small sample left, right? So, and what I'm going to show you today that you actually don't need to do that if you use big data analysis, and we're going to discuss all of these issues. All right. So first, I'm going to talk about my background. I'm going to talk about overview of big data, unsupervised learning, and this is my favorite part. The unsupervised learning is a big data component, and then we're going to talk about unsupervised learning on noisy data, and we're going to discuss applications, how to do spectral clustering to generate superior returns. So stay tuned. So first, my background. I'm an electrical engineer, and after being an electrical engineer, I started working when I was an electrical engineer. Basically, I was studying electrical engineering basically right away. I was doing software development for financial services, and from there, after finishing my electrical engineering, I went into financial engineering. And I started doing trading globalization at the same time in major banks. And I enrolled in PhD. I was doing IEOR, which is Industrial Engineering Operations Research, which is basically applied math at Columbia. And there I took a year off. I went to do my MBA at INSEAD in France. So after I came back, I was more interested in finance. So I switched to a PhD in finance. But in the process, I've worked and worked and worked. So I did risk management, and I even ran a loan quantification book at the major bank. And after that, I did ETF research and equities research, more traditional equities research. And then I ended up on a trading desk, and was a foreign exchange trading desk, where my job was to develop automated trading strategies, basically observe what people were doing on a trading desk and build kind of automated models. So that's how I got into high frequency trading, because that's essentially what my job description was there. And so we started building some high frequency trading strategies. And then we got seeded in New York City, $20 million to run these strategies. And that's what I was doing for some time, until one of our clients came to us and said, hey, we just want to buy your data. And it was over 10 years ago, and it was very novel. Nobody has heard about alternative data at that point at all. And nobody was selling really data to anybody. But we said, yeah, why not? So we ended up selling data to this major hedge fund. And we have been basically doing it since. And in 2014, we went completely data centric. So our company, Able Markets, is really, we develop and we process and we sell data as streaming feeds. So these data are basically like real-time research. All right, so we consume the information, and we process. In many cases, we buy all the exchange information in the United States, and in many cases abroad. We also consume all the news that there are, and we develop real-time predictions. So in the case of news, and this is one of our latest products. It's not on the website yet, but what we do is we basically perform equity analysis that traditionally takes somebody, let's say, 2 weeks to write a report, and we summarize all the news that there are in about 15 minutes. Okay, so and we do it across Russell 3000, and we can expand it into currencies, commodities, etc. And we generate a kind of an index, right, of 0 to 100 in terms of buy 100, sell 0. So this is kind of an example of things that we do. But we also have new products that interpret weather, interpret different patterns, and help help researchers kind of make their job easier in terms of basically showing what to look for in the current enormous explosion of news that I'm going to talk about today. All right, so I'm honored to be an adjunct professor at Cornell University, and I'm also tremendously honored and grateful to be just asked to teach at Cambridge University in the UK. And of course, I have a book on high frequency trading. It's High Frequency Trading, a Practical Guide to Trading Strategies and Trading Systems. It's the second edition that came out in 2013. I'm a co-author of Real-Time Risk, which came out in 2017, and a co-author of Big Data Science and Finance that actually just came out in 2021 in March. And it's written with the world famous Marco Avellaneda of NYU, who is an absolute expert in this field and has been teaching big data at NYU for the last 10 years. And he's extremely knowledgeable, and I'm very grateful to have co-authored the book with him. So this is the new book. You can definitely pick it up. And it's basically, it's a mathematical textbook, more or less, but it explains in great detail the fundamentals that underline the big data in finance. And I think it explains them in a very good and intuitive way. So we worked a good 3 years together on this. And it's really been a product of it came from the heart. So we really put a lot of effort into it. Okay, so I'm just going to talk briefly today about some components of the book, but of course there's a lot more to be found in the book. So why are we here, and why do we see what we see? Well, of course, it's the technology, right? So over the last 70 plus years. Since first computers were developed, the cost of technology has gone down, and the processing power and speed has gone drastically up. And just to give you an example, when I started working in computers, I never worked with punch cards. Actually, it's not true. I remember I was at my mom's job and she used punch cards. So I have worked with punch cards in a sense when I was very little. But when I started my real work, when I was studying electrical engineering, my first computer was Alpha DEC. And I don't know if any of you remember those, but it was just this giant machine. It required its own room. The room had to be air conditioned because this machine produced so much heat. And of course, it was the major noise generating technology, entity. And it had the tiny black screen. And on that tiny black screen, you could see what you're typing. It was black and white, right? So that's how I started. Of course, today, fast forward, you can buy the same machine of the same processing power. It's all on a tiny laptop, and it probably will cost you around maybe $300. At that time, that machine cost $20 million. Okay, that I'm not going to mention the dates, but also besides costing $20 million, it required a ton of money in monthly maintenance and air conditioning, electricity consumption, all of these lovely things. So, this is how far we've come in terms of technology in really a pretty short period of time. So the biggest fintech areas today that are being driven by this technology are payment services, which is basically very popular in Latin America, of course. We have online loans. Yes, you can, in the US at least, you can now fill out application online and basically have a yes, no on the mortgage in about 30 minutes. So we have automated investing, and that's something I'm going to talk about too, and data analytics. And that's the most important and the largest area of all of this, because there's so much data, as I'm going to talk about, and there's so many ways to basically skin the cat to analyze it. So as described in our real-time risk book, it's really fintech boils down to A, B, C, and D, which is artificial intelligence, blockchain, connectivity, and 5G is going to bring an enormous amount of data onto our screens. And D, of course, for data. And today, with big data, we're focusing on A for artificial intelligence and D for data. Okay. So let's move to the next point. So what is artificial intelligence? Well, artificial intelligence is exactly what you think, minus the cyborg image. So it's kind of a computer program that can perform human tasks. So it can perceive and understand the world around us. It can communicate in natural language. It can reason and make logical deductions. And of course, it can make plans, decisions, navigate the world, coordinate with other machines. So there's many, many things that where it can go. So big data, pure data that we're experiencing today, is basically all the social media and all the internet. Everything carries information. So we don't have just traditional news. Excuse me. We have news that are generated by everyone, right? So you go to Twitter, you write something. To some people, it's information. And of course, now we have smart devices that are coming online. And those smart devices are these RFID chips, radio frequency identification chips, and they're already widespread in places like retail stores. So in the US, at least, when you come out of a retail store, you go to the checkout counter, they scan your device, they scan the barcode, but they also disable this little metal chip with a labyrinth kind of pattern on it. And what this labyrinth pattern contains is information about which item you're buying. And when it's scanned, all of this information goes into a giant centralized computer. So in principle, you can track in real time how many, if you're a hedge fund or somebody else, you can track how many bottles of Tylenol are being sold across the United States in a given minute, right? And from that, you can infer what the earnings are going to be of Tylenol, the maker of Tylenol. So this is the kind of thing that we're looking at is still in the next 5 years or so, to actually being able to deal with such granular data in real time and actually predict the price from this information. And for that, we need 5G. So right now, our network bandwidth is just not big enough to process all this data. But once 5G is fully rolled out, we will be able to do that in a snap. Okay, so this is also how big data differs from traditional analysis. So traditional analysis is hypothesis based. So what that means is, in order for us to analyze data, somebody needs to ask a question, right? This is the usual statistics. And the question has to be yes, no question, right? So for example, we can ask the data and say, hey data, do you think the price of the stock is going to go up tomorrow based on the data we have? So that's a yes, no question. And then after we form this yes, no question, and the question is definitely formed by person, by a human researcher. So the question is biased. It's not naturally biased by the person's experience, by this person's ability to ask questions, right? By this person's kind of universe, the ability to see outside of the box. So this question is only going to be as good as the person who is asking the question. So, but let's say that we have a question, and then we're going to take this question to the data, and we're going to torture the data until we get the yes, no question, usually in the form that we like. So if we're convinced that there has to be some predictability, we can tweak the analysis in such a way that eventually it will say, okay, there may be some predictability, okay, if there's no obvious predictability. So it's basically traditional analysis. That's how traditional analysis works. Now, if we look to big data analysis on the right side of the page, we have 3 different types of groups of big data analyses. So the first one is the supervised learning, which works in many respects like the traditional analysis. Then we have semi-supervised learning, which is also hypothesis driven, but we have more prediction feedback. I won't have time to talk about this today, but I think it's a fascinating area. And it's really, this semi-supervised learning is something that allows you to copy the kind of wrap a system around a human expert's head. Okay, and if there is somebody who has like really superstar ability to make predictions, you can observe this person's inputs and outputs, and you can actually build a system that kind of makes these kind of things. So an example for this maybe the traditional way it was developed mostly at companies like Facebook and Google, and what it was used for is to classify images. So, for example, Facebook has a policy that no offensive images are allowed. So, but it was too cumbersome for a person to actually sit there and check every single image all the bloody time. So, they have come up with a system that looks at a few images that are classified by person, and then it expands this to all the other images. Okay, so this is semi-supervised learning. There's several techniques in that. It's not just one technique. But in finance, this translates very well into, let's say, research. Okay, so you have one superstar analyst, and let's say that's all you can afford. All right, but you want to expand this person's brain in a sense to other domains. So kind of expand the productivity of this person to other entities. All right. So let's say this person is focused on specific stocks, but you want this person to handle more breadth. So more breadth of data. So you can use this semi-supervised learning to do so. All right. And for even better result, you would have semi-supervised learning produce some results, and then you would feed them, basically give them back to the person to review. And that way you increase the productivity even further, because you're saving your star analyst time and really making sure that the star analyst is kind of now supervising the systems instead of really doing the grunt work. So you're letting the semi-supervised learning do the grunt work for you, for your organization. Okay, and then we have unsupervised learning, which is amazing. It's completely different from the traditional universe, and here we let the data speak for themselves. So we really are basically asking the data. We're giving the unsupervised learning models the data, and I'll show you. It should be dirty, completely unpolished data, and we say, "Hey, data, tell us what you think." Okay, and the data tells you what you think. Now, there's still a range. There's still need to interpret the findings. It's not exactly straightforward. So you still need a person to translate essentially what the data is saying into the human language. We have not yet evolved these systems to the point where we can actually translate automatically, but I'm sure it's coming. But at this point, you still need a researcher to really translate the findings into to explain it to people. But it's a different level because data itself is unconstrained. These unsupervised learning models, they're unconstrained by any human biases or by any human opinions or beliefs or anything along those lines. It's really telling you what the key drivers are in the population. And we'll talk a little bit about how it does today. Okay. So, but here is the key kind of illustration about how the supervised traditional versus this unsupervised analysis works, just to give you a flavor. So here's an image, and I'm going to talk a lot about images today because I find it fairly easy to illustrate the concept in terms of images rather to jump straight into financial data. But but I'll talk about financial data as well. So this is an image, okay, and it consists of red and blue dots, and these red and blue dots are labeled as female and male. So if you apply traditional analysis, you will just run a regression, do something with these red and blue dots, but you will completely miss that there is a bigger picture in the data. Yet unsupervised learning can tell you that there's a picture in the data and that these female-male categories are irrelevant. Okay, so this is just an example. All right, so but more broadly, what we're trying to do with any data modeling is we have a set of inputs, we have a set of outputs Y, and we have nature in the middle that translates X to Y, and we're just trying to model it. Now, in traditional econometric modeling, we assume specific data model that we're trying to fit, whether it's linear, logistic regression, or whatever it may be. Okay, in alternative modeling and data science, we just let it loose. Okay, so we let the data science models to determine really what the relationship is, and it can be non-parametric, as we'll see, in many different ways. Okay, so these are the supervised learning models that I don't have time to go into details, but they're all described in details in our book with Professor Marco Avellaneda. And here are the different classes. Now I'm just going to very briefly touch upon them. So this is the neural networks, right? And obviously this is a joke, but it's really, in a nutshell, it's a sequence of nonlinear transformations that we're stacking together and trying to approximate exactly the function. And you can do it very easily in Python, right? Python is now the new Excel. But there are numerous applications to both intraday data, like high frequency data. So this is, again, an example of K, nearest neighbors algorithms. And it's used to forecast changes in S&P 500 constituents on 30-minute basis and produces fantastic results. Okay, this is described in detail in the book, Big Data Science and Finance. And here's supervised learning overview in general. We're trying to minimize quadratic loss, just like in ordinary linear regressions. But this is where the overfitting problem comes in. Okay, so this is the classic kind of overfitting example. So the model is really stitched too closely to the data that the data has no room to breathe. Okay, and so imagine what happens out of sample when we produce this to the model. You know, if there's a change in any conditions, then the model cannot do anything. The model just cannot move, right? So this is the major hazard with traditional econometric models and unsupervised learning. Supervised learning tries to resolve a little bit of them. Unsupervised learning does a great job at doing that. Okay, so in general, we have several models in supervised learning. Again, I can't really, I don't have time to talk about all of them, but this is a comparison of different models. So this example, again, it's a visual example, but it applies to a lot of the financial data. Okay, so we have true faces in the first column, and we had like several thousand more faces, pictures that were available for training of this model. And we delete the bottom part of the face. Okay, so we take the half of the face and we erase it, right? Bottom half of the face. And then we use these different models such as extra trees and k nearest neighbors and linear regression, basic linear regression and ridge regression. All of these models are described in detail in our book, Big Data Science and Finance, and we're trying to reconstruct these faces. Okay, so what you can see here is different performance of different models. And clearly the linear regression performs the worst. You know, it gives you the skin condition there in pictures. It's really disgusting. But and a lot of people are like, well, you know, this is not that great. And it's not. You know, the other models like Ridge, for example, or KNN, I think or extra trees, they do a lot better than linear regression. But they're not perfect. Like, they don't perfectly reconstruct the faces. But if you think about it, to trade successfully, we don't need a perfect reconstruction. All right. So what we do need is really just 56% of predictability, you know, if we have normally distributed returns. So we just need a slight tilt to the positivity. And these models deliver us much, much, much better than just a slight tilt to positivity. These models deliver us, you know, probably 80, 70, 80% predictability. And in case of Ridge, like we have an example in the book in predicting treasury rates, US treasury rates, Ridge can deliver 86% predictability, or 80, 89, something along those lines. So, you know, there's a lot of value in this over traditional analysis. So, but of course, we do need more. As we can see, we can do better. Okay. So we have semi-supervised learning that I've already talked about in the beginning. When we have a good and thorough analyst, and you know, and in general, it's just becoming there are too many things, too many news sources for an analyst to handle. They're just, you have to cover the social media, you have to cover Twitter, you have to cover all the news, and it's just too hard. So these semi-supervised learning models help you really digest all this information and just put it on your desk with maybe a keyword summary. That's what our firm Able Markets does, okay, or a score, all right, and from there you can basically work backwards and add some personalized your opinions to really help you do the work better. Okay. So here's how semi-supervised learning sort of works. It's a very brief introduction again. So we have what's called label data, okay, and we have a small set or medium set of, let's say, news sources, okay, like or for several stocks perhaps, and all the tweets and all the social media. And then the analyst thoroughly goes through all of these, and she or she assigns ratings to all of these items. So ratings, and without labeled data is Y. Okay. Then we have a lot more of unlabeled data. It's called unlabeled data, which the analyst has not touched. So, and this is what we're going to try to use we will use the labeled data to predict the unlabeled data. And there's a basically, we're going to use bootstrapping and built-in latent variable analysis, okay, together, and that's the innovation of the semi-supervised learning to bring these two together to really develop the forecast for the unlabeled data. So to label the unlabeled data rather, okay, and pretty accurately. So again, we describe this in detail in our book. I don't have time to talk about this. Right, but let's move on to the next point. So this is the unsupervised learning. Now I'm in love with unsupervised learning. This is all I want to talk about all day. Nobody's listening to me that much in my family anyway. I can't wait for this COVID to be over. So thank you so much for being there at the presentation. So anyway, so this is an image. This is Professor Feynman, who used to be Nobel Prize recipient in physics. And he also was one of the famous quants, okay? So these are, and what this image is, it's a matrix, right? So from our perspective, it's a data matrix that has 454 rows and it has 366 columns, all right? Instead of this, and it's a black and white image, so all the dots, all the matrix elements in this image are points ranging from 0 to 255, okay? So from our perspective, this didn't have to be financial perspective. It didn't have to be picture. This could be financial data set where in rows you have, let's say, the S&P 500, most of the elements of the S&P 500, and in columns, let's say you have a year and a half worth of return or something along those lines. Okay, so we're going to decompose this image using singular value decomposition. You can also do principal component analysis, which is a close cousin, as we show in our book. There's a very simple mathematical relationship between the two. The advantage of SVD, though, is that you can use it on a rectangular data. It doesn't have to be perfect square data, right? So we're just going to use SVD on this. And this is the singular values. So these are the singular values that we get from this. Again, all of this is described in detail, how it's all developed in our book. And these are singular values. They come out neatly ordered. Okay, so they neatly, in this case, they're ordered from roughly 40,000 to close to 0, and they will necessarily have this elbow. Okay, so every singular value graph is going to have this bend in it, which is referred to the elbow as the elbow. And this elbow really separates macro drivers from the micro drivers, as I will show you shortly. So first of all, this plot is called a scree plot. Okay, it was named as such by a psychiatrist who developed this seminal paper in 1956, and he became essentially the father of data science, believe it or not. So a scree is a slope covered with rocks. So there are dots on that line that you can't really see, but this is where the word scree plot comes from. Okay, so this is a scree plot. It basically connects the dots, the singular values, and there are so many dots here that looks like a straight line, like a smooth line, but in reality, of course, they're data points, and that's very important part of what I'm going to talk about. So, there are macro drivers above this elbow, okay? And if depending on your application, you may be interested in the top portion, like the macro drivers, or you may be interested in the micro drivers, okay? Idiosyncratic drivers, so the very tail of the singular values. So there are different approaches to this, okay? So what we're going to do now, we're going to focus for now on the macro drivers. We're going to cut off the macro drivers at the very top, and we're just going to analyze what's called eigenvectors. Again, all of this you may have heard about, but it's all described in our book. And we're going to reconstruct the images. So what is an eigenvector? Well, in the first figure with peak was 1. This is the first eigenvector. Okay, so eigenvector, it's not just one column of data. It's a linear combination of all the columns. So an eigenvector gives us a vector of coefficients, all right, by which we need to multiply each individual column and then add them together. So as you can see, it gives us when we display this just the original data set just cut off to the first eigenvector, we get kind of a white blob there in the middle, right? And it's not much else. So you can see with the second, when we add the second eigenvector, so we keep the 2 eigenvectors now in the image, we get a little bit more kind of background. Okay, then 4, we now have the outline of the picture, the outline of the image, and here's Richard Feynman. And with 100 eigenvectors, we already have pretty much a neat reconstruction of the key portions of the image. So we just took 366 columns and we essentially reduced them to 100 factors here. Okay, so if you don't believe me that this is how it works, our book has a website which is called bigdatafinancebook.com, and there's an application which you can do it with your own images. All right, so you can upload your own image. It's completely free. There's no sign up required, and it will give you this decomposition of different images into different number of eigenvectors. So, go ahead and try it. Again, the website is bigdatafinance.book.com. All right. So, but of course, there's a limitation. So, we have Richard Feynman here, but SVD still picks out when the interesting thing is SVD picks out the most important features of the image. So you see, like the pictures about Richard Feynman, and when we get these top eigenvalues, we actually picking out the most important trends, and it's picked out completely by the machine. All right. So but the trick here was, of course, the focus of the data was on Richard Feynman, right? This is the argument you can make. So we're going to redo this with another famous person. This is Frank Fabozzi, and I'm using his picture with his permission. He's the editor of the Journal of Financial Data Science, and it's a brand new journal, has been around for about 2 years. But you see here, he's using his own camera, which is not as advanced, of course, as the Richard Feynman picture here. So it focuses, but it's a regular internet camera, and it's still, we do 50 eigenvalues, and we can still pick out Frank out of the picture. We're not picking up the corner of his chair or the handles on his cabinet behind him, right? So we really, it's really does a great job, this technique, at picking out the thing. Of course, we have some noise in the background, right? Some of the stuff is not that relevant, but the point is, it does pick out, factorize out the best what we need to actually find. All right. So, so some people think that there are better techniques than this, but I'll make an argument that the unsupervised, like random forest, which is a supervised technique, are better. I make an argument that this is the unsupervised learning is state of the art, okay? And on top of everything else, it holds up much better to noise than traditional models, which allows us to use the entire population of data, every single bit we have, instead of like calling and cutting data to this little tiny box that may not be representative of the general population at all. So, and there are traditional noise versus signal metrics that are all described in our book. Okay, and this is just a Wigner semicircle. You may or may not have seen it before. So basically, when you have a square matrix where all the elements are normal 0, 1 IID, okay, then if you take the eigenvalues and then you take the histogram of those eigenvalues, you will get a perfect semicircle. I mean, how cool is that? Okay, but this result is like from 1931. So we're going to move forward and look at more recent results. So here, this result, Marchenko-Pasteur theorem, again, we cover it in detail in our book. It's basically, you don't need to have any more normally distributed data. You can take any distribution of data, okay? And it will tell you, this model gives you an envelope around the distribution of eigenvalues if the distribution contains no signal, all right? So if you have no signal, basically your data is completely meaningless and there's nothing to look here, then you will get this perfect red line envelope around the distribution of your eigenvalues. But if you do have a signal, in that case, you will get the spike. You can see the spike at the end that's sticking out from the red line. So the spike tells you that there is a signal in your data and there's something you should look at. So again, this is Marchenko-Pasteur. This was also developed in 1962. So it's not a spring chicken here, okay, but it's extremely powerful. All right. So there's also Tracy-Witham distribution. Sorry, the Witham did not make it onto the screen, but it tells you where to look for your eigenvalues. All right. So you can actually mathematically see if the first eigenvalue falls into its distribution where it's supposed to fall, and you can do the same for other eigenvalues. But the point is, if it does not, then, and if it's outside of this distribution, you know that there is a signal, a very strong signal in your data. Okay, so this is something also you can do. But the interesting part is really to see how this relates all to noise. Now, I don't have a huge amount of time left, but I'm going to run pretty quickly through the rest of the slides. Again, all this is in the book. So we have a Mona Lisa here. We're going to deconstruct Mona Lisa. So the data is hugely correlated. So this is the correlation of different columns, right, and at the bottom. It's really, obviously, we have smooth transition from one column to another, so it will be very correlated. So with this kind of data, we have to apply Kerhunen-Loewe transform to really the trend, the scale, and then deconstruct the data, and then use Marchenko-Pasteur on the data. But the interesting part is what happens if we actually make Mona Lisa noisy, all right? So we're going to add a bunch of noise to this picture. And why do we care about this? Well, this is the strength of this unsupervised learning is, for example, in high frequency trading, your data may black out. All right, so you may have a bad internet connection. You may have your slow processor may slow down for whatever reason. You can have other malfunctions and bottlenecks. And what you want to see is, okay, what happens if some of my data is lost? Okay. So the answer is, if your data is lost at random, your unsupervised models are going to stay just as stable as they do when all of your data is received. And I'm going to show you why. Now they're different. These things are holding up as long as the data is not a self-selection problem. And a self-selection problem, as you know, is, for example, if you're a portfolio manager and you have bad returns in a particular year, you just choose not to show them. That's really not cool, but you know what I mean? That is a self-selection problem. So this what I'm going to show you does not work with self-selection, but it works with data missing at random, for example. All right, so if we in this case, we're adding blackout, meaning we're adding zeros, random zeros throughout Mona Lisa, basically blacking out some numbers, okay? We're putting zeros instead of the existing numbers. And this is the common way how we deal with missing data. If we have missing data, we just stuff a bunch of zeros in. So what happens is hard to see in this chart. It's hard to see in this chart. This is white out. We also try putting 255 in instead of 0. But here we can see the changes in the original eigenvalues. So if we take the difference between the resulting eigenvalues after blackout and the original eigenvalue, we can actually see significant changes now, okay? So here we're going to have relative changes in eigenvalues from the blackout to the original, and we're going to see how the data performs. And what we see is for the top eigenvalues, right, that we usually use for macro analysis, there are no changes. So there are absolutely no changes in eigenvalues even if you throw in a bunch of garbage data into your data set. So you don't need to clean the data set anymore, because when you're cleaning the data set, you're potentially throwing out very useful observations just because they're partial observations. Okay, so what this is showing us that you can still use the data that's extremely noisy, extremely messy, and obtain very, very strong unsupervised learning inferences if you're interested in the top macro drivers. Okay, but even if you're interested in the tail, if you're interested in idiosyncratic drivers, you're still going to do okay, right? Even if you use super noisy data, because most of the noise comes out in the eigenvalues in the middle of the spectrum, around the elbow. And this is something you would toss in any case. So it's irrelevant, all right? This is another example. These are relative changes for the whiteout. So instead of replacing everything with black, zeros, you're replacing it with 255, which is white. Okay, you still have very strong inferences on both ends of the spectrum. Stronger on the macro drivers where there's zero changes, but still okay on the micro drivers. There's all sorts of additional research that people have done that I don't really have time to talk about. I'm just going to quickly run through these random perturbations. You know, if you add random data, you add exactly the same result, which is mind-blowing for traditional analysis kind of sense. But so and we're going to talk about now is basically the results. So we have this unsupervised learning is super stable. It's invariant to randomly missing data, which is great. But what we also want to show is financial data, of course. So this is top 5 eigenvalues of the S&P 500 correlation matrix, and it's computed using a rolling window estimator. And, you know, it doesn't really change if we add a bunch of garbage into this data. We just randomly replace these returns with zeros. So what this tells us is that we can now add illiquid securities to the mix, securities which have zero return, right, because they're just not traded, and we can intelligently do portfolio analytics with these. Now, how are we going to do that? And I have very, very little time to talk about, but 3 minutes, but we're going to use it using Davis-Kahan theorem and spectral clustering, which is a very cool way to really separate these different different components of and relationships using unsupervised learning. So I don't have time to talk about, but it's all described in a huge detail in our book, and all the different processes and even the programming in our book website. We have the programming available. So you can just download Python code, but it's better than Kmeans. So this is a traditional Kmeans. If you have a bunch of clusters, it finds these centroids, or basically means of the points, separates points into different groups, right? But this doesn't work if the groups are non-nicely distributed. So it only works for convex groups, like here. Okay, if we and if you're thinking, you know, save me from clustering, I don't blame you. But it's a but if we want to do something more complex, okay, then we really have to look to spectral clustering. And what we can, let's say crypto, okay, so this is our crypto up to the last run, okay. I'm sure we can repeat the analysis with the last crazy crypto movements, but what we're showing here is we can improve the performance of crypto using this spectral clustering by first splicing them into different clusters, okay, and here we show the comparison of K-means clustering versus spectral clustering. So we splice them into different clusters, and then we equally weigh the clusters to actually achieve much superior results. All right. So and these are the Sharpe ratios for spectral versus K-means clustering versus equally weighted clustering. Basically, spectral clustering comes out on top. Again, it's all described in detail with charts in our books. In our book, Big Data Science and Finance, you can do the same analysis for commodities. Okay, and also you'll get much more superior results with spectral clustering than, you know, with equally weighted. If you just do equally weighted Sharpe on commodities, you get pretty much zero. But with spectral, you get some serious meat. And this is basically how your portfolio performance is going to work. So the green line is equally weighted, blue line is K-means, and spectral is orange. Okay, I hope you can see the colors. And this is for 2 clusters. That's for 5 clusters. All right. This is for 10 clusters. You finally are seeing performance by the spectral clustering, and K-means is rising to the occasion as well. But as you go higher to 15 clusters, spectral clustering is really going on a kind of a what do you want to call it? Basically, it's doing well. All right. And so for 20 clusters, you already have K-means outperforming equally weighted portfolios, and spectral is off the charts. All right, 50 clusters doing way better for both K-means and, of course, spectral. So there's a huge value to this technique in all sorts of financial data. All right, and I highly recommend it. Now, if you have any questions, you can email me. It's Irene at ablemarkets.com. Here's my email at the top of the page. I'm also on Twitter. Follow me at Twitter, Irene Aldridge. I'm on LinkedIn. Just Google me. And I hope you enjoyed this presentation, and I welcome all questions now. So please let me know of any questions you may have.